Okay, great. Well, thank you for everyone for joining, taking some time out of your trading day. It is sometimes difficult to do these during the trading day when you actually have trades going. But and also thanks again to Trading Pub for putting this on. Let me go ahead and move this slide forward and just give you a little bit of background about myself in case you're unfamiliar. I've been trading since 1991. I graduated college and was a retail broker to start out, and then began trading full-time shortly thereafter. AlphaTrends.net is my website where I have a chat room that we look at stocks intraday every single day, and that's not the entire service, of course, but I do videos which outline what the market is doing, what I think it is likely to do, and then low risk, high probability stock trades. That's the main focus, is individual equity trading. So as it was mentioned, I've been mentioned a few times in Barron's and Time Magazine. If you follow me on StockTwits, I've got 71,000 people who follow me over there, and a little over 11,000 people on Twitter. I'm sorry, on YouTube. So if you go to alphatrends.net and sign up for the free report that's there, it's going to show you an infographic that we're going to be looking at here shortly, and also a swing trade report. That by signing up for that, you'll also receive each Friday a weekly video which outlines what the market is doing, potential levels for it, and potential scenarios, that is. And some individual stock trades I throw in there once in a while as well. And actually last week I'd mentioned Bitcoin. So let's just go ahead and get started here. We've got a limited amount of time, and I want to make this as valuable as possible for you guys. So what we're going to talk about again is just looking for high probability trades and low risk. And for me, it means trend trading. There's only one reason any of us is in the market. I mean, a lot of people seem to like to get into the market to argue with other people. To me, I never take the other side of an argument. I only take the other side of a trade. Only price pays. It's not an intellectual exercise or an academic debate. It's about making money. That's the only reason we're going to get involved in stock trading. And I'll be the first to tell you that it's not easy. So if anyone tells you that it's easier, that they have a system that's going to work all the time for you, run away from those people. Don't get involved, because it's hard work and it's about discipline. And we'll talk about what some of the biggest mistakes are that I see people making. We'll talk about some trades that Alpha Trends members are involved in right now, or were set up, or we may have gotten stopped out. So there, the reason to buy a stock is, again, to make money. But what motivates people to make those decisions to buy or sell? The market is always, you always see the market was down because of this or that. And a lot of times the headline writers scramble to find a reason. Well, a lot of times it's just because it broke past resistance or it broke down through support. It's not always about, the jobs report or fundamentals. The market today isn't 10% fundamentally stronger than it was 3 weeks ago when people were puking their positions out in mid-October. So we have to have a strategy. That's the key. I mean, you can look at fundamentals. You can look at, and I look at fundamentals once in a while, just, basic stuff. To me, it's about the only two things that really matter to me fundamentally are, one, is the company selling more stuff? That means their revenues are increasing. And two, are they making more money doing, selling whatever they're selling? Because at the end of the day, all stocks are eventually valued on earnings, or they're based on they're valued today on their earnings potential in the future. And if they have no earnings future, well, then they're going to be most likely in downtrends. But does the story make sense is something that is very important to a lot of people who are involved in the market. So they gravitate towards those fundamentals and look for the reason. And there's no problem with understanding what the reason may be fundamentally, but you can't let that get in the way of managing the risk and making money. Only price pays. I say it over and over again. In fact, there's a great website out there which is www.onlypricepays.com. If you take a look at that, there's some real good information, and I think that everyone should bookmark that site. anyways, technical analysis is more about when to get involved. It tells us, it allows us to look objectively at the markets and say who's in control. Is it the buyers or the sellers? Who's in control of IBM right now? IBM, you know, Warren Buffett is a big holder of IBM, but they reported earnings, I think, about 3 or 4 weeks ago, and the stock gapped down, and it's been stuck in a downtrend. It might be a good company, but it's a terrible stock to own right now, and we want to own stocks that are in uptrends, and we want to short stocks that are in downtrends, and if we're not sure what the trend is, then we want to basically just avoid them and wait for a low-risk opportunity to present itself. There's no reason that you have to trade Apple every single day, or have a position long or short in the S&P 500. There's times where cash is a position, and the market, if you interpret the market's action correctly, the market tells us when to be involved, long or short, or when to avoid it. So what we want to do is, even if you can combine the fundamentals with the technicals, then that can even give us a better opportunity. And I was mentioning in my chat room this morning that I think that the idea of Taser right now is something that reminds me a little bit of Tesla when Tesla was about $40 a share, because Taser has earnings that are growing. They've got increased revenues, and that's good fundamental information. They've got backlogs of orders, new products, and that sort of thing. And I only know this by looking at the headlines for the company. I almost never, ever read an entire news story. One, I don't know who the author is or what their bias may or may not be. I want to know not the opinion of the author, but the opinion of the market. So when I see a good company, sometimes I get to take a look at sometimes I will take a look at the fundamentals, and I did for the case of Taser, because there's also a very big short position in there, and the short sellers seem to have it wrong because the stock is in an uptrend. So I think that could possibly add upside fuel to the fire. Shamel's asked me, am I going to get into intraday charts? There will be some intraday charts, absolutely. What we're doing today is an educational segment. It's not a trading segment. So I won't be doing any live trades if that's what you're expecting or hoping. We're here to introduce you to a trend alignment strategy, basically. And this is something that I talk about every single day on Alpha Trends, in my videos and in the chat room and in our webinars. And in a larger education class that's going to be coming actually in early January. It's going to be an 8-hour course, and it's going to be a $99 course. So you can find out more about that on the alphatrends.net. But what we want to talk about here today is having a formula for consistent success. And it is truly a formula. Stock trading is a business. You can't just say, okay, well, what's up today? What's down today? If you want to be that kind of active day trader, I guess that's fine if that's what your strategy is. But the strategy that I've found over my 20-plus years of experience to show the highest probability and lowest risk opportunities is what I call trend alignment. That's the strategy, and it's based upon the market structure and how the market trades, how money typically ebbs and flows in and out of stocks or in the market or whatever the vehicle it is that you're trading. So we want to then use that analysis to come up with an objective, that objective analysis rather, to come up with a risk-reward ratio. And we have to remember that what we look at, and we think that our risk is 50 cents and our reward is $2. So the market, that means nothing. It means absolutely zero what we think. So those are just guidelines to point us in the right direction, to say, if I'm right, does it seem like it's worth the risk, basically? But the risk reward might be nothing, meaning that we just want to excuse me, the risk reward is theoretical. If the stock goes down right from the beginning, there was no reward, and the market didn't the market didn't agree with our analysis. But if the market agrees with our analysis, then of course we have to continue to objectively manage that risk and raise our stops on the longs that are working, lower our stops as the shorts decline. So the most difficult part to trading isn't coming up with a system or a method that makes sense. The most difficult part is the discipline and applying the, getting over our own psychology and our own ideas that maybe a stock is up too much or it's down too much or that, this idea doesn't make any sense. What we want to do is we want to be completely objective and leave these emotions out of the equation. This is the typical emotional cycle that you see for long traders. That is, as the market begins to move higher, people say, well, this rally is based on nothing. I mean, you think back to the financials back in 2008 when they bottomed out and started to advance. People kept saying, well, this is a bad rally. It's not going to happen. Don't people read the news? Well, the bad news comes out at the bottoms, and good news typically comes out near the tops. So what we want to do is we want to just look at price action objectively and say, at this point, it breaks past resistance. So if it breaks past resistance, then perhaps we can get involved. And at this point, let me see if this works. It does. Okay. So I've got the ability to draw on here, which makes me happy. Anyways, the ability for us to say, okay, it's now breaking beyond resistance. And then we have higher highs and higher lows. What we want to do is we want to have a strategy that says, where do I get involved in this trade? At what point do I get involved? By the way, the market's breaking down a little bit here, and I'm thinking that the NASDAQ well, we'll talk about the market more in a moment, but I think we have to look at the possibility that today's breakout in the S&P 500, now that we're negative in there, is the possibility that from a failed move might come a fast move lower. We're just losing a 5-day moving average for the first time in a while, and we'll talk about that in a moment. And I'm sorry if I have a little ADD here, but I'm looking at the market as well at this time, and I'll try not to be distracted by that. Anyways, back to what we have here. We want to be the people who are, bragging about the stock, say, hey, what did I tell you, I'm the man. You see people on Twitter do it all the time. It's so annoying. They're arguing about a position, or they're saying, well, I don't like that idea. Well, I give stock trading ideas all the time, and I tell people, don't trade it exactly the way I say. Make it your own trade. Personalize it and say, here's what makes sense to me. Or if you don't like the idea, then ask me about it. Maybe you're going to point something out to me, but don't do it in a challenging way. It's just stupid. Negative people are who wants to be around them? Anyways, the point is, this is the emotional cycle we want to leave behind and become completely objective in our analysis. Looking at the market structurally allows us to do that, to break it down into segments, and we have to do that on multiple time frames as well. So the S&P 500 right now is in a clear uptrend still. Now, are we breaking out here in a failed move? We simply don't know. That's what risk management does. We have to say whatever time frame we're involved in is where we want to manage the risk. By the way, this infographic here is something I put together a few years ago, and it's been extremely popular. And you can get that, as I said, this is what you can get access to by signing up and putting your email in on alphatrends.net. Because this is bigger and you can see it obviously a lot better. What this does is it takes the 4 stages, stage 1 accumulation, stage 2 uptrend, stage 3 distribution, and stage 4 decline. And up here, it tells us just a little bit about what these different segments of the market are. And then down below, it breaks it down into stage 2.1, 2.2, and 2.3. So sub-stages to say, here's where we are, here's where we have the potential to be. So take a look at that, and we're going to talk more about this. This is a, I've forgotten what chart this is at this point, but this is a good example that says basically, stage 1, okay, is over in here, where we have prices crossing back and forth above and below moving averages. Moving average crossovers represent indecision. They're not a reason to buy. We want to buy when the market makes a higher high above these moving averages and they're flat to rising. And then we want to look for places to raise our stops or to purchase after a pullback occurs and it begins to move higher again. We don't want to buy pullbacks because we don't know if it's the pullback that's not going to bounce. So we want to look at it and say, stage 1 is where this is what's known as accumulation. And in accumulation, that's where we anticipate. Maybe we set an alert at 27 bucks a share to say, okay, this is where I'm going to get interested in the stock. And then we participate in stage 2, in the markup phase. We participate long. And some people will try to short these pullbacks in an uptrend. And if that's your strategy, then then that's fine. But keep in mind again that the sum of the rallies is always going to be greater than the sum of the declines in an uptrend. So again, what's the definition of an uptrend? Higher highs and higher lows. So the stock rallies 3 points, pulls back 2. Stock rallies 5 points, pulls back 4. Just the very definition of higher highs and higher lows tells us that the opportunity is greater on the long side when there's a primary uptrend. If you're going to fight those trends, you do so on a very shorter time frame. You drill down to a shorter term time frame and do so with smaller share size and absolutely control your risk. Anyway, stage 3 distribution, we tend to see that it becomes indecisive as we have moving averages cross back and forth again. Then when it breaks below the low of stage 3, then we have lower highs and lower lows below flat to declining moving averages. This is a confirmed stage 4 decline, and it's what I consider guilty till proven innocent, meaning that we're going to look at that and we're going to not trust the rallies. I can't tell you how many times I have people ask me about stocks that are in clear downtrends that might have rallied 10% in a short period of time, and they're wanting to get involved. And I say, look, we're right at the declining 50-day moving average. Odds favor that we do not continue higher from here. Odds favor failure. So guilty till proven innocent in a downtrend. Then we have more indecisive. Basically, stage 1 and stage 3 are indecision, and you want to avoid being involved in those. There's just, there's no point of being involved in there. And by the way, I'm going to, I see there are some questions, just so we don't get distracted and end up taking too much time and not getting through the material. I'm going to ask that everyone kind of holds their questions back, and I will get them at the end. So hopefully we'll have enough time to get into all of those as well. But the cycle then repeats, and after that indecision, do we know if this is a sideways that will break down, or do we know that it's accumulation? We only know that it was accumulation once it breaks the higher high. And then we use our definition of trend and say higher highs and higher lows. So it's made the higher high. I'm going to set my stop under the higher low, and I'm going to continue to look objectively at the price action in the market. So that's the idea. Now, this slide just kind of outlines a little bit of what I said, but stage 1 accumulation occurs after a price drop. It's the point where big institutions are getting out of prior positions that they've had, and they're looking to and new institutions are getting involved because they might see something. It's a real slugfest, and it's a real boring time for the stock, and in a time where there's indecision. And my opinion is just leave it alone. Stage 1 and stage 3. There's no point really in being involved in those stocks. Stage 2, higher highs and higher lows. They're innocent till proven guilty. Stage 4, lower highs and lower lows, guilty till proven innocent. That's the way you want to look at it from the bigger term picture, and then drill down to shorter term time frames to try to fine tune the timing and to assure that you're getting involved when there's momentum and that you don't put yourself in a position of a lot of risk. So what we talk about is trend alignment, and basically it's based around Dow theory. The Dow theory is the underlying premise of all technical analysis, and that is that there's three types of price trends. The primary trend, which is a longer term time frame. Charles Dow compared it to oceanic tides that can last for years. The secondary movements, they can last 2 weeks to 3 months. Those are compared to the waves, and then the little insignificant ripples are the short term. Now what we're going to talk about is swing trading. So what we want to do is we want to combine time frames. That's what trend alignment is all about. We look at the long-term time frame to find the potential trade candidates. That's where we say, okay, here's what the primary trend is. Here's what the path of least resistance is for XYZ. And then we say, okay, now I know that I've got a stock in an uptrend. Now I want to look for a place to buy. So then I'm going to drill down to an intermediate term time frame, the key levels that we've recently seen support or resistance found. This allows us to go in and objectively say, how much perceived upside do we see in this long position compared to what we perceive the downside, the risk. So is there a favorable risk to reward ratio? If there is on that intermediate term time frame, then we put it on our radar, we set alerts, we keep it on our screen, we look at shorter term charts, and on those shorter term time frames, that's where we look at it and say, now this is where I fine tune where my entry or exit will be. And the time frames, of course, are going to vary depending on whether you consider yourself an investor, you're a swing trader, or a day trader. So for a swing trader's perspective, and I'm not sure I have it on this next slide, well, this just kind of, I'll talk about that in one moment. Let me just talk about this slide. I put this together probably about 3 weeks ago. And this was the Russell 2000 for 2014. This is where we closed last year. That's the blue line. And each different shade of green or red represents 1%. So you can see this is the unchanged line for the year. And we've seen a very volatile market in the Russell 2000. And here we are, back up somewhere around this area once again. It's for this reason you look at it and say, what's the trend on this time frame? Well, you could say it's neutral. I mean, we're trading within this big range, I guess. But when you break these pieces down to shorter and shorter time frames, then we look at it and say, now we can make sense of it. I don't know how to enlarge the slides, and this narrow vertical, I agree, it's a new format I'm experimenting with, and I think it would represent a lot better horizontally. So anyways, just go along with the concepts. There's nothing specifically there that you need to see in detail. But what we want to look at is, again, what are the time frames that we're interested in? Now, for me, the way to really objectively, quickly identify what the trend is to say, what's the direction on a shorter term time frame? So on a shorter term time frame, you can go full screen. Yeah, at full screen you can do. However, he's talking to think about the format of the slide is more like a page out of a book. Most times a presentation will have it a little bit wider. So anyways, nothing I'm going to do to change that right now. So back to a swing trader for a moment. If we talk about the time frames, if we go back 2 slides and say, what is the long-term time frame if you're a swing trader? Well, if you're a swing trader, it's my belief that the long-term trend is best represented on the daily time frame. That is, we want to look at a chart that goes back. Typically, I'll look at about maybe 200 days, and then that tells me what is the trend. I'll look at on the daily time frame for a 50-day moving average. If I see the 50-day moving average is advancing, I just generally consider that innocent till proven guilty. If I see if it's declining, just real quick 2-second indicator. If the 50-day moving average is declining, I look at that stock and I say that stock is guilty till proven innocent. It's in a downtrend. It's not likely to provide me good long opportunities. So is there a short here, or is this in a void? So if I think that, let's say I've got a stock that looks maybe something like this, okay, and we've got the 50-day moving average like that. Well, I don't want to buy it up here. I want to wait for the pullback and then monitor and buy it not as it's pulling back, but as it begins to move higher again. And I'll look at an intermediate term time frame, which for a swing trader, I consider the best time frame there to look at would be a 30-minute or a 65-minute chart. A 30-minute chart, if you just think real quickly, I'll explain the logic because I always get a question about this. Each day the market's open from 9:30 a.m. to 4 p.m. Eastern, and that says the slides are not available for download. The market is open from 9:30 to 4. So if you broke that down into 30-minute time frames, there would be 13 of them. So what I look at is I want to look at a 5-day moving average on that 30-minute time frame. So over the course of 5 days, if the market is open for 13 30-minute periods a day, over the course of 5 days, the market is open for 65 of those 30-minute time frames. By the way, this market is a short in my opinion, at least for a day trade, if not a little bit longer. So for instance, with the Qs, I think you can be short in here with a stop of about 102.75. And anyways, because I am short. Anyways, let's take a look then. So we've got the market open 13 of these 30-minute time frames. Over the course of 5 days, there are 65 of those. So a 65 period moving average on a 30-minute chart will give you your 5-day moving average. If you're not familiar with that, type into Google 5-day moving average alpha trends and you'll see some good information about that. Then we're going to drill down to a shorter term time frame. And in this case, it might be a 10-minute, a 5-minute, a 2-minute. People ask me constantly, what time frame do you look at? And my answer is I look at all of the time frames. I want to be as accurate as possible. So going back to here, when we look at a weekly time frame, let's say we're looking at a daily chart and it's breaking out to a new 52-week high. Well, then at that point, it becomes important to look at the weekly time frame and say, okay, where has this stock come from in the past? Are we breaking an important level here? Or is there something I need to be aware of? Is there a prior big area of support that might turn into resistance? That's what I want to be aware of and look at the weekly time frame. So just a real quick, what's the most important moving average on a weekly time frame? I consider it to be the 40-week moving average. 40 weeks because there are, that's equal to the 200-day because there's 5 days in a week. 40 weeks, so times 40 weeks, that's 200-day moving average on a weekly time frame. That gives us the really longer term trend for that stock or for the market. Now, so let's talk about the S&P 500, the SPY right now. The SPY, if you look at the 200-day moving average, it's way down near about 192.5. It's really not much value to us at this point for a short-term trade. Here we are, 11 points above it. There's no point. But from the longer-term perspective, it is still heading higher, and that's why that recent sell-off, in my opinion, didn't stick, is because it was still heading higher. If we had a flat to declining 200-day moving average and experienced a big pullback, I don't think you would have seen it rally back to new highs like this. Anyways, on the daily time frame, again, maybe they're just generally about 200 days, and I'll look at a 50-day moving average. If you want to look at the 50-day moving average on your weekly time frame, well, 5 days in a week, a 50-day moving average is equal to 10 weeks. And, the moving averages, let me talk about for a moment, they're there only as a reference point. A lot of people will say, hey, it's at the 50-day moving average, should I buy? No, you should look at it and say, okay, it's at the 50-day moving average. Now I want to look at a shorter term time frame and see how it's behaving. Is it just slicing through that moving average, or is it actually showing support on a shorter term time frame? It's not a system, it's a tool to help us find objectively what is the trend and how can I participate without putting myself at too much risk. So I want to anticipate what others are doing by looking at that moving average that other people find value in, but I want to look for the actual evidence that the buyers are showing up before I even think about buying. On an intraday time frame, again, as I was saying, I'll look at anywhere from 10 to 30, 40, maybe 50 days sometimes. If I look at a 30-minute time frame, again, 65 periods is the 5-day moving average. And if you look at even the S&P 500 right now, the SPY, it's been riding this the 5-day moving average since it crossed above it back on, October 17th. And right now, for the first time since this rally has started, we are below it. Now, it has a rising 5-day moving average, so I don't expect an immediate rollover, but maybe the S&P gets down to about 202.75, 203, and then rallies up, shows a lower high below it, and then perhaps we see a more meaningful pullback. But right now, again, the 5-day moving average is still advancing, so if you're going to be trading short, then your time frame should be that of a day trader, basically. So on the very short term, I'm adding a fourth time frame, I realize, a 1 to 2 minute chart, meaning each candle or bar, whatever you look at, is equal to 1 or 2 minutes. And I will look for 1 to 2 days, and I'll look at what's known as the volume weighted average price, or the VWAP. I talk about that a lot. We don't have time to get into the volume weighted average price, so I will just say that do some reading up on that, because it's an incredibly valuable tool And if you have a decent trading platform, it should be available on that. But the moving average is just a reference point. Again, it's a constant to compare price to. It's a way that we can objectively say, here's what the trend is. And again, on a weekly time frame, when we look here at the S&P 500, what we see is we've got this the 40-week moving average right down here, and it's heading higher. It's way down, way lower. Or, I'm sorry, this is Apple. It's way down at 92 or so. On the daily time frame, here's a 50-day moving average, and again, we see that with a rising 50-day moving average, even closing below it, it's innocent until proven guilty. It doesn't mean we buy it down here. It means we anticipate that when it gets back above the flat to rising 5-day moving average and makes higher highs and higher lows, then it's innocent until proven guilty. And then, so for instance, yesterday's daily chart, we saw a quick rally. It pulled back to the volume-weighted average price, then higher highs and higher lows, and it remained above that volume-weighted average price. So those are going to be the most important moving averages you can look at if you're looking at one single moving average on any time frame. Looking at the next slide here, what we really want to do to show consistent success in the market is we want to have a method of getting involved. The method is, one, we want to anticipate where the scenarios are. You're best off doing your homework outside of market order hours, when your emotions aren't running wild and you're not prone to making, to jumping in just because you see it moving quick, or just because it was mentioned on television or someone spread a rumor or whatever. That's not a consistent approach. That's going to have you chasing things. It's going to have you let your guard down, and you're going to make mistakes. In order to minimize the mistakes that you make in the market, your analysis should be done while the market is closed. You don't want to let the emotions get involved again. So what we want to do again is we want to scan for stocks and anticipate where the best low risk, high probability trades are setting up. And using technical analysis, we can do that quite objectively. So we want to look at it and say, what is the potential for this stock? What's our risk reward ratio look like it's setting up to be? And then when we have our ideas, our job is then to monitor the market and say, set alerts, to have a chat room you're in where people shout them out, whatever it might be, a reminder of some sort that says, hey, I think the stock is breaking out beyond $23.85. So I want to get involved above $23.85. Or let's say, for instance, a stock that we're involved in today, Mylan Labs. Mylan Labs, we've been watching this for the last 3 days, saying that back above $54.23, we wanted to get involved. So maybe you set your alert at $54.20, and as it alerts, you say, okay, now I have to look at that chart because last night I understood here's the risk-reward ratio. So now I'm going to look at it on my level 2 screen. I'm going to look at my 1-minute chart and say, are the buyers taking control? Do I want to get involved? Snap decision. And you already know, if you're wrong, where your stop is going to be. So for instance, our stop in Mylan was, I don't remember where the stop was, 53.50-ish. Anyways, you want to wait for the price confirmation before you actually get involved. And then our number one job is that of risk manager. Winners do not take care of themselves. People say it all the time, oh, the winners take care of themselves. That's not true, because I've seen it so many times. Someone was lamenting in chat today that that they were involved in Taser, and they had seen it go $1, $1.50 higher from their entry, and then they took a small loss on it. So that winner didn't take care of itself. The idea is to look at shorter-term time frames and be aware maybe of the story in Tesla, but if it starts breaking down, Taser rather, if it starts breaking down, then you have to move to the sidelines and be in cash. So managing risk is your number one job, and managing your emotions puts you in a better position where you can objectively manage that risk. So before we get involved in any stock, 2 questions you want to ask yourself. And this is something people will say, again, one of the biggest mistakes I see is that people will say, hey, Brian, what do you think about Alibaba here? And Alibaba's chart looks like this. And right here they're saying, what do I think about Alibaba? and this was, you know, 90 bucks a share, and here it is 119. I'll say, well, where has it come from recently? Well, just rallied 20% uninterrupted over the course of several weeks, and hasn't experienced any pullback really at all. It's still above that rising 5-day moving average. So, you know, it's come a long way. Where does it have the potential to go before it's likely to encounter resistance and find you know, supply? Well, when you have a stock with an all-time high, you don't really know that answer. There is no prior support that has the potential to become resistance. But you say, is there enough potential profit relative to the risk? If your stop is way down here, and maybe this is 113, do you want to risk 6 points buying at 119? What's your potential upside? After the stock has just rallied 20%, generally not a good time to get involved. So when we're trading long, what we want to do is we want to look first at our primary trend on the daily time frame. And again, that can be as simple as saying it's above a rising 50-day moving average. So that goes in my potential long pile. Now, if it's way above that 50-day moving average, it's not going to be as good of a setup up here as it would over here at this point. Okay, so if we don't want to buy up at this point, we want to let it pull back, and then as it begins to move higher again, then we want to participate. But what we want to do here again is all we're doing on that daily time frame is saying it's in an uptrend. It's higher highs and higher lows above a rising moving average. It's in this until proven guilty. Now what I'm going to do is I'm going to look at a 30-minute time frame that goes back 30 days. And this is where I'm going to ask myself those two questions. Where has it come from? So if it's extended at this point, I'm going to say, you know, I don't think it's just run 15% in the last 4 days. I'm going to pass on that one. Instead, if it's down here, well, it's just pulled back. It's in a healthy uptrend. You can look at the volume maybe that was increasing on the way up, and that volume was pulling, you know, decreasing on the pullback. So you say, okay, I like this one. In here, you know, this, what I want to do is blow that up basically. So it would look something like this. And right here, this would be this circled area in here, okay? So what we would be looking at, let me change the color of this pencil to red. Okay, so this right here is equal to that right there. So what we're doing is we're saying, okay, now I want to anticipate. This is a stage 1 accumulation on the 30-minute time frame. It just experienced this pullback, which was a stage 4 decline. Here's stage 1 accumulation. This is where I want to anticipate. I want to say if it breaks this high above $54.23, then I want to get involved. And my stop will go below this little higher low right here at $52.50. So I know that's my plan. Now, if it gets above there, and you know, this is where we have a higher high on an intermediate term time frame, this is where the momentum is just beginning. Some people will look at it and say, oh, but the volume's not there yet. And you know, volume tends to follow the direction of the price. That people become more confident as they see volume increase. But the volume typically increases as the stock is rallying, and you know, you're chasing it up in here. This is where it makes the higher high. This is where you participate. That's where you buy the stock. Okay? And then we say, here's where our risk is. This is where our stop goes. Now, as long as it makes higher highs and higher lows, I want to raise my stop up underneath those higher lows. If you follow me on StockTwitch, you see that I didn't quite do that. I posted a trade about Bitcoin and buying it at 352, and I was raising stops, but I also figured, hey, it's close to this 400, so I booted it out at 398, and then it went on to 425 or so in the next several hours. But the point is, there's no perfect way to trade a stock, which is why I don't tell people what to do. I give them the idea and say, here's what makes sense. Now manage the trade and make it your own trade and manage risk on the way that you look at the market. How much time do you have to commit to trading the market? What's your risk tolerance? It might be much greater than mine. For most people it is. I tend to have very tight stops. I tend to sell my winners early. These are my weaknesses, but they've also become my strengths here because this is what's allowed me to stay in the markets when I've seen so many people blow out and be consistently profitable. And consistently profitable doesn't mean profitable every day or even every month. but it means that on balance, I have more winners than losers, and not by a whole lot, but my winners are typically bigger than my losers. So our job in stage 2 is to participate and to manage the risk. As the stock runs up, let's say here's where we are, this is our little trend, it starts to turn sideways, and we have moving averages crossing back and forth. That's generally the time to exit. And as it pulls back into that stage 4 downtrend on the intermediate term, just avoid it. Because again, the primary trend is higher highs and higher lows. So if you're trying to short these, unless you know that it's for a scalp trade, so for instance, this short that I'm involved in the Qs, then you have to say, okay, I'm on it in it for a very short period of time. I'm trading it off a different time frame. Know the time frame that you're trading on. But again, short term is where you fine tune your trading. Now, for the long side, these are a couple of stocks right here that I had for subscribers this week and last night. Groupon had broken some resistance at about $7.30 a share. It did so on a nice surge in volume. It pulled back on diminished volume to a rising 10-day moving average. And I didn't want to buy it a rising 10-day moving average, but instead I look at the secondary trend, here a 30-minute time frame, and you can see I simply have a 5-day moving average. It showed these higher high and higher low. That's this area right here. And then it pulled back, which is this, and consolidated. And this consolidation, what we did was we bought it on strength above the consolidation high right here with a stop under there. It ran up to 8.20 or so yesterday, and we raised our stop to $8.02 a share. And this morning we were stopped out at $8.02 a share. And right now it's $7.81 a share. So, did I want to get involved to make 50 cents? No, but that's what the market told me was prudent, and that's the way you want to listen to the message of the market and be comfortable with the stop that you're in. LOCK is another one that we're involved in, and as far as I know, it hasn't hit our stop yet, but we have, so it's not. So we have a stock that's in a primary uptrend, higher highs and higher lows, above a rising 50-day moving average here on this daily time frame. It's got potential, I think, towards, if that was a straight line, up towards 18 or so. But we bought it on a break past resistance yesterday with our original stop below this higher low, and we raised our stop up to this level here, which is about $17.20. And right now, we currently have our stop at $17.22. So even though we're involved at $17.28, the worst risk we have here is 6 pennies. I don't know if this stock is going to go to $22 a share, or if it's going to pull back below 22 cents and we lose 6 pennies a share. All I know is we have an objective plan that was laid out beforehand, and we're not going to be whipped around by the emotions that may or may not be correct to look at. Here's Alibaba. Now Alibaba, actually if you look at my stuff and you saw me on Yahoo Finance, on this day right here, I was talking to Jeff Mackey on Yahoo Finance, and I said, listen, if Alibaba can get back above that 91, 92 level, that puts it above the volume-weighted average price since the stock came public, and that's this level here, and it gives us a higher high above a rising 5-day moving average. So I said at this point, if getting above 92, I think should be, enough to send the stock up north of $100 a share. Well, here was 100, but look how it continues to hold that rising 5-day moving average. My problem again is, one of my issues in the markets there that I don't hold my winners. Clearly, Alibaba could have still been held and made a nice trade into a huge trade. But again, trade according to your personality and what you see setting up. For short sales, and again, this you got to understand here, there's a lot more to this. You're getting a 1-hour version of something that, quite frankly, takes people years to figure out. But there's an 8-hour class where I'm going to be discussing this in January. And again, go to alphatrends.net, and I think it says education or trading academy, or I should know this offhand. But that's where you can sign up to get more information about it. It's only going to be 99 bucks. On the short sales, though, it's the opposite. We want to start out with a stock that's in a downtrend below a declining 50-day moving average. If it's below that declining 50-day moving average, it's guilty till proven innocent. It's going to get up once in a while. It's going to, it's going to fall down and it's going to get up and think it's okay. It's going to be like the punch-drunk boxer who gets up and thinks he's okay, and then it just takes one little tap and it sends him right back down again. And that's the way those stocks are. They're guilty till proven innocent. Yes, they can rally, but they just don't have the ability to stay higher typically. Now, you don't sell short just as it's rallying because you think, well, okay, it's in a primary downtrend, so I'm going to short because this was prior support, so it should be resistance. So you don't short there because it may continue to move through it. Instead, you say, okay, that did turn into resistance. Now it's heading lower. That's when I want to get involved. So when we have the primary trend is lower, again, we look at the intermediate term time frame and we say, okay, here's where we have that decline, okay? And if we take this area here and we were to blow that up, so let's say that's a daily time frame, we blow that up to 30-minute candles, the end of that looks like this, and then right in here. So as it breaks this support, so basically what we're saying is this is our stage 2. Let me change the color of that to blue. So this is our stage 2, and then here comes stage 3. So this is stage 2 right here. This is stage 3. So in stage 3, when the primary trend, the daily time frame is a stage 4 decline, we want to avoid that stage 2 uptrend. But when it gets to stage 3 distribution, this is where we anticipate the trade. We say, okay, if it breaks support at $42 a share, I'm going to get short with my stop above this lower high at $42.65 a share. And if it's truly in a downtrend, then it should at least take out this low. That becomes my objective. Not my price target, but my objective to say it seems reasonable that it should head back down to there, if not lower. So we enter right here as it makes that lower low. The stage 4 decline sets up on the intermediate term time frame, and then we manage risk. We take our loss if it goes back above here, or as it makes lower highs and lower lows, we take partials off into real strong drops and then lower our stops. That's the strategy, very basic. So for instance, in gold, if they don't scare you out, they'll wear you out, and we know what happened with gold. It broke that support, and gold is still guilty till proven innocent. It's in a downtrend. There's no reason to be a buyer of gold, not if you're looking at a daily or a weekly time frame. There will be bounces, there have been bounces, but if they don't scare you out, they'll typically wear you out. Now, here's a stock that we are currently short in Alpha Trends from yesterday at 50.48, and then again this morning, as it dropped below last week's low. Last week's low was $49.87. And here we see on the daily time frame, GLNG got hit real hard. This prior support acted as resistance. We've got a declining 50-day moving average. Then what we saw happen on this decline was we saw it rally. It was making higher highs and higher lows above a flat to rising 5-day moving average. Then it broke support, and a declining 5-day moving average said, now we have a stage 4 decline on the daily time frame. Here's where we're seeing that we can enter this stage 4 decline on the intermediate term time frame. This morning what we did was we had we took half of it off at 48.28, which is basically where the stock is right now, because 48.28 right down here was where we had daily S2, and we lowered the stop on the bounce. So we're still short a half a position with a stop of 49.05 in shares of GLNG. And these were slides I put together last night. LNG is one that isn't one that we're involved in short, but it's actually breaking this level here today. Now the problem is, so this was as of yesterday's close. Here's another energy name. Big uptrend, breaks down hard, rallies up, finds resistance at the declining 50-day moving average, and on the intermediate term, it's actually tracing out this head and shoulders pattern. 70 is the key, but when it closed yesterday at 71.87, you don't want to short below 70 bucks a share because it's just dropped $2. Where do we put our stop? So this is one that we were looking at to anticipate. So right now we're slightly below it. What I'd like to see in the next day, day and a half would be a slight rally that creates a lower high, and then to short weakness in there because it's in a stage 4 decline, and we want to see now that 70 to 70.5 becomes resistance. If it does, then I think this one could head back down pretty quick and pretty fast. Another one that I haven't even mentioned to subscribers, it's kind of on my radar for a potential short. FAST is clearly in a downtrend. You can see it broke down on big volume with a declining 50-day moving average right in here. It came down and found some buying at about 40, what is that, 43.5. Rallied up, and here we see again this rally. You could have made money on it, but it failed. And with a declining 50-day moving average, you simply don't trust those. So as we broke down the next time, we broke down through that prior support, and then it rallied up, and a lot of people were trying to short it right here, saying, hey, it's at resistance. And as I always say, you only know resistance after the fact. You don't know while it's there in front of you. So at this point, at 43 bucks a share, I can't even read the writing, but you know, did we want to short there? No, because we have a rising 5-day moving average saying it's in a stage 2 uptrend on the intermediate term time frame. It's an avoid. We don't want to sell it short until it does something more like this, which is that it turns sideways and that 5-day moving average flattens out, begins to turn lower, then it makes lower highs and lower lows. I think that Fastenal could be a good short setup, but it's not there right now. So we have to anticipate. And remember, technical analysis is a tool. It's not a system. If you're using it as a system, you're going to find it very frustrating. It doesn't always work like the textbook will tell you. We have to look at it as something that says, here's what I'm gonna look for the potential trade, and then I'm going to try to determine what the scenarios are so I know in advance where to take action, what price and when to take action, and if the market agrees with me, to adjust my stops. It's great for recognizing trends, for timing, for risk management, and for implementing your strategies, but it's not there to say, hey, it's touching the 10-day moving average, you have to buy it. That's the way fools use technical analysis. Don't be one of those foolish people that says, hey, it's touching the 50-day moving average, I'm going to buy it. Look at it and say, it's touching the rising 50-day moving average. Now I want to dig a little bit deeper and see what's going on the shorter term time frames. If you do it that way, you're using technical analysis properly. If you're just looking for cups and handles and heads and shoulders and dojis and shooting stars and other really what I consider to be secondary nonsensical noise, you're going to find yourself very frustrated with technical analysis. So what, again, we want to do is we want to be an expert in any market environment by looking at multiple time frames, and that's what this class is all about. So again, we're going to be doing this this class, 99 bucks. There will be 4 1.5-hour live webinars that will be recorded as well, which you'd have access to, and then 1 2-hour webinar at the very end of it. So it's 8 hours of interactive education where you'll have quizzes as well. There will be self-graded quizzes to understand the concepts, and it's likely to be held, as I mentioned, early January. You just go to alphatrends.net, subscribe, and see the information there. Last thing I wanted to mention very quickly is where I trade. It's a question I get a lot of times. I have a couple of accounts, but one that I'm excited about, I've been trading with for a couple months and really happy with, is with Liquid Tree Group, liquidtreegroup.com. They're a proprietary firm. You set up a membership with them, and you can get some great leverage. Number one, they have unbelievable access to short inventory. Anyways, I would say send an email if you're interested in more info to trader@liquidtreegroup.com. They have automated risk management. You can get started with $5,000 and get $50,000 buying power. You keep all your profits and good commissions as well, so it's really a great deal. That's going to do it for here. Shamil, I don't know if I have that name right, is will this be in a live market? The live market, no, this will be after hours. There's no way I'm going to do that course and give up 8 hours of live trading. It's a $99 course that's designed to give you the fundamentals. If you're interested in the a live approach, then I would say everyone should go to alphatrends.net and take a look at the at a 7-day trial to the gold membership where there's a chat room, and that's the live aspect to what I do, Shmuel. And again, I'm sorry if I butchered your name. What platform do I use? I personally use Realtic. I think they're, you know, at Liquid Tree, it's a Sterling, which I don't think is as good as Realtic, but they're going to be getting that there. Linda, and how much do they charge for trades? I would say go to Liquid Tree Group and investigate that. Send an email for Trader. I'm not a representative of Liquid Tree, so I would say, you know, ask them. And by the way, if you do sign up for a subscription to Alpha Trends, because we're doing this with Trading Pub as a promotion, what we've done is we've set up a discount of 15% by using that code that you see in your chat there, TraderPub15. If you insert that in, you'll be entitled to a 15% discount to whatever membership level you take advantage of. If you have other questions, that'd be great. Otherwise, I think we're going to wrap this up here. I think we're scheduled to end at 12:15, which is why I'm in Colorado. 12:15 is 10 minutes away. So if you have questions, feel free to pop them in, and I'd be happy to answer those for you. Frank, are you going to do another one? Frank, I'm sorry. Frank has taken 6 free trials over the last several years. I don't understand it, Frank. I'm sorry. The code is there in the chat. If you sign up, Frank, no discounts for you. I'm serious. It's crazy. And I don't mean to call you out on there. I'm surprised to see your name and after the number of free trials you've done over the years. So could I please comment today's SPY and Q situation? I think that, you know, for the SPY, we have the possibility that this is, you know, we've had a great rally here over the last 3 weeks. The SPY is up from 181.5, let's say, up to 204. Today we saw, you know, 204 and change is a high. It's been riding this rising 5-day moving average. We're still clearly in an uptrend. We're in a bull market. It's had a fantastic run. I think it's time for this market to pause a little bit, correct through time, and if we break down below probably 202.5-ish, and we stay below the 5-day moving average, then I think that we're likely to see a pattern of lower highs and lower lows on that intermediate term time frame, and maybe we come back down towards 200 or so. We're still in a primary uptrend. Shorting in an uptrend is extremely difficult. You have to be very nimble. You have to be willing to move to the sidelines quickly and be involved on the shortest term time frame. So if you're interested in my opinion in analysis of the markets, the SPY, the Q, the Russell 2000, I look at Apple every single day as well. It's only $249 for a year to access to that end-of-day video every single day. And again, if you don't even want to do that, then you can go sign up for the email, and you'll get a email every Friday with the information, the videos that you know, they're generally viewed about 3,000 times or so on YouTube. I've been doing them for 8 years or so. Other questions? Matt says, thank you, Brian. I always enjoy your work. Thanks, Matt. Thanks for tuning in, and glad that you find value in the work that I do. No other questions? Okay. Well, I guess that's probably going to wrap it up then. Any thoughts on Brocade? It's in an uptrend. It's innocent until proven guilty. I don't have a position in Brocade. Some of the people in Alpha Trends chat were involved yesterday. I think that if you're involved in it, your worst case stop right now probably goes at about $10.80 a share. But, you know, it's had an extended run from 9 to 11.25 for a stock that usually doesn't trade in big ranges. So it's getting a little bit extended. I think the name of the game in there is to protect your gains if you're in it, and I wouldn't be looking to get involved up here. That, you know, it's had too big of a run to make a new low risk purchase. Opinion on VXX? Yeah, VXX is a product that I think most people should just stay the heck away from. It is toxic. It is poison. It is designed to go to zero. It goes down to, you know, $10 a share, and then they do a 1-for-4 split. They've done this 6 or 7 times. It's a bad product. I tell people just stay the heck away from it, Frank. So I'm not going to give you a look at the chart, I'm going to give you my biased opinion, which is based on fact that it's a piece of garbage overall. If you hold it for more than a week or two, you're going to lose. BlackBerry, it's breaking out. It's just broken some resistance here today at about 11.5, 12. There was a little band of resistance between 11.5 and 12. It's breaking that on heavier volume. The trend is higher. Perhaps it goes to fill the gap up towards 14.5. I wouldn't buy it here though. Just in the last hour and a half, it's run close to $1. I'd want to see it pull back, create a higher low, then buy on strength. But it's heading higher. I certainly wouldn't want to be short the stock. Even if there's a new symbol that's tradable for, a new formula of VIX, old formula of VIX, I just think that VIX in general is something that 99% of people who look at VIX truly don't understand it. I just don't even look at it. To me, it's noise. There's just no point to it. I'm not gonna try to be an expert in everything. And if I don't understand it, then I'm just going to avoid it. I'm not going to try to learn it either, because I've seen so many people try to learn how to use the VIX, and I have never met anyone who has consistently used it for anything valuable. It tends to be noise, and it's just a terrible product to trade. Okay, well, that's going to do it. Yana just put in the code for the subscription again. And if you want to take a free look, go ahead for 7 days. You won't get charged after that. And I know, there's a reluctance to put credit cards in. I hate that too. But it keeps people, hopefully, from signing up for 7 free trials, coming back with new emails and that sort of thing. But if you want to take a look, that's great. Find out information about the class coming up. And then, of course, sign up for the email. I promise I don't spam. Send you a weekly email. Once in a while, I'll send you an email that says, hey, I've got a free webinar coming up or something like that. But you're not going to see your email filled up with spam messages. So thanks again, everybody, for taking time out of the day, especially when we have a live market here. And thanks to Traders Pub for hosting this event. Hope you found it useful, and some of the other speakers have provided value as well. I would say that you're probably going to hear a lot of different things. Grasp on what makes most sense. Does trend analysis and looking at price action make sense to you? If so, explore it further at Alpha Trends. Thanks again for tuning in, and best of luck in your trading.